Today's webinar is mainly aimed at those who are currently living in the UK and considering relocating to Gibraltar, although it could apply for those going in the other direction. Or maybe that you're living in a different jurisdiction and you think Gibraltar or even the UK might be the home for you. My name is Matt Penfold, Director and Advisor here at Fiduciary Wealth. If you want to find more information about us, visit our website, fiduciarywealth.gi. Okay, so planning your UK exit and the UK statutory residency test. So a lot of people we talk to who want to move to Gibraltar, they have a lot of ties in the UK and they want to move to Gibraltar for the better lifestyle, better climate, the location closer to Europe, or just from a kind of financial point of view from the taxation. But quite often people want to spend a lot of time in the UK still. They may have business interests, they have family there, whatever that may be, kind of leisure activities. One thing that we always highlight is that you need to assess the UK statutory residency test and assess that with a professional, be it ourselves or someone else. And in brief, the UK statutory residency test effectively tells you, once you exit the UK, how many days that you can spend in the UK before re-triggering UK tax residency. So a lot of people think, okay, I moved to Gibraltar, I spend 190 days in Gibraltar. That leaves, say 175 days in the UK. That's less than half a year. That's fine. That's not true in a lot of cases. The UK statutory test looks at the number of ties you have with the UK. So business interests, family, property, how many days you spent in the last couple of years. And based on those ties, that will effectively dictate how much time you can spend in the UK without re-triggering tax residency. Now, this can be as low as 30 or as high as 182. But it's important to assess that because if your motives to move are financial, there's no point in establishing Gibraltar residency and then still being liable for the larger UK tax. When you are planning your UK exit, our recommendation is to always try to plan that towards the end of the tax year. So in UK, that's end of April, and then it's a clean break. It's not always possible, and you can have a split tax year under some circumstances, which is when you move to start a new job in Gibraltar, your spouse has taken up a new job in Gibraltar, your main home becomes Gibraltar. So what they mean by that is you sell your UK property, you buy one in Gibraltar. Otherwise, then you may have to evaluate the days in that tax year that you're spending in a certain country, even after you move. So, for example, you move in January 2024, you've already spent the majority of the tax year in the UK from April up until December, over half the year. So that period, January to April, for the end of the UK tax year, you are likely to still be a tax resident in the UK. So be careful with that. People may get caught up. They want to take advantage of the taxation benefits in Gibraltar, but for that period, they may still be UK tax residents. And the second part of the UK is your UK domicile. So we have kind of two assessments. We have your tax residency, which is primarily based on the number of days you spend in a country or where your main home is. And then you have your domicile. Now, your domicile in the UK, we acquire at birth. Generally, it's where we're born, where our parents were born. So if you're born in the UK and your parents were, you have a UK domicile. Or if you move to the UK and you spent many, many years in the UK, you are likely to have acquired a domicile, which is the UK. Now, the reason we mention this is inheritance tax in the UK is based on your domicile. So some people mistakenly believe that they move to Gibraltar or elsewhere, they exit the UK, and therefore they're no longer liable to UK inheritance tax because they're living in Gibraltar. That's not true. Firstly, you need to spend at least 5 full tax years in your new home. And then even after those 6 years, if you still have connections to the UK, ties, you still may be liable to UK inheritance tax. So if you have property there, you're traveling back and forth a lot, you still retain bank accounts, business interests, things like that. HMRC will look at that and think, well, okay, they're living in Gibraltar, but that's not their home. They intend to return to the UK at some point. So they remain UK domicile, they remain liable for UK inheritance tax. It is a difficult one and complex. It is possible to shake off your domicile, but not entirely. There's no official way of measuring it. And of course, when you do pass, you are not there to defend your position. So you pass away, you believe you're no longer UK domicile. HMRC challenge you, which there have been situations that they do that. You're not there to defend yourself and protect your assets. So we always say prepare for the worst, and then nothing can go wrong. And there have been high profile cases of Richard Burton is one that people mention a lot. He was outside of the UK for 20 years, severed all ties, he fought, took advice, professional advice, but he retained a UK burial plot in Wales, his home country. They returned his body there to be buried, but he always had this burial plot. And HMRC challenged his estate successfully. They argued he always had connections with the UK. He always intended to return in one way or the other. He's a UK domicile. And they were successful. 40% of his estate was taxed. Inheritance tax is a huge amount. And they refer to it as the voluntary tax, because there are steps you can take to avoid that if you plan properly. And some of that we will cover later. So we move on to the tax comparison. So inheritance tax, I've just mentioned that. The good news is no inheritance tax in Gibraltar. The bad news is you may be still liable to inheritance tax in the UK. The second lot of good news is, as an expat living in Gibraltar, there are planning opportunities that you can take advantage of to reduce or even completely remove your UK inheritance tax liability. We'll cover that later. Income tax can be considerably lower in Gibraltar. For normal tax, if you're employed just under self-sufficiency or an employed basis or self-employed, there are two different tax schemes. There is the allowance basis or the gross income basis. So it depends on your individual circumstances. In the UK, income tax works on progressive tax rates. We get the personal allowance and it's 20, 40, 45. Gibraltar, it works slightly different. It works on what they call a bell curve rate. So the rate of tax you pay increases, and then it reaches to a peak, and then it goes down for the final amount. And the way that works out is it means the maximum average tax rate you could pay. Well, it was 25%. That's now increased to 27%, but it's a temporary measure. For 2 years post-COVID, they introduced that. I think we'll be coming to the end of that soon. Let's see if they stick to their promise and reduce that down. But overall, the income tax, it does depend on your individual circumstances, how much you're earning, where your sources of income come from. There's a lot of different factors to take into account there. But the fact is, it's generally kind of lower. If you're on the allowance-based system, you earn less than 11,450. You're completely exempt from tax. On the gross income-based system, the first 10,000 is at 8%. Then the next 7 is at 22%, and we keep going up like that. So it's important to assess that on an individual basis, but it's generally, in pretty much most cases, lower taxation. Capital gains tax in Gibraltar is 0. That's in comparison to the 18 and the 28% in the UK. And more importantly, now in the UK, there was the allowance, I think 12,300. That's now reduced down to 6,000 for this tax year. Will go down again to 3,000 in this tax year. So UK, you've got a 3,000 allowance. After that, you're paying 18 or 20%. In Gibraltar, there's no capital gains. A lot of people think this is a great opportunity, which it is. You can realize capital gains on maybe investments or a business that you hold in the right circumstances. The one thing that is very important, that you cannot return to the UK within 5 full tax years. If you do, then you'll pay that capital gains tax for the period that you were out. So it's effectively like you've never left. Clearly, that's to avoid people, leaving the UK for a year or two, realizing a huge gain and returning. So 5 full tax years before you can return. Dividends in the UK, it's again dependent on your income. You're paying between 39.35, as I say, dependent on the income tax band you're in, so how much you're earning. If you're living in Gibraltar, due to the terms of the double taxation agreement, it is possible, and this needs to be professionally assessed, but it is possible to receive dividends from a UK company free of tax in both jurisdictions. So effectively, the UK says, okay, you're not a tax resident here. You pay the dividend tax where you're tax resident. Gibraltar says, well, the dividends are derived in the UK. You're responsible for paying tax there. So because the UK says, no, we're not going to tax, potentially no tax on the dividends, which can be a real win there. No VAT in Gibraltar, which is fairly well known, and corporation tax is lower. It was 10%, it's 12.5% now. they suspect that that will go up to 15% in line with the kind of minimums in the EU. And then your pension income. So this will depend on the sort of pension that you hold. There's some pensions that you have to continue to be taxed in the UK. So we're talking about maybe NHS pensions sometimes fall into this, UK government pensions. If you can transfer your pension to a Gibraltar scheme, so to a Gibraltar Q-ups, then the income is taxed at just 2.5%. So there's a great incentive there. If you transfer to a Gibraltar pension, income tax at 2.5%, you still get your 25% tax free as well, which often isn't the case when you move outside of the UK, but in Gibraltar it is. And then you need to consider the timing of the sale of your UK main residence, so your main property in the UK. So in the UK, we live in our main property. We don't pay capital gains. We only pay tax if we're selling rental property or additional properties that you hold. In Gibraltar, you sell your UK main property. There's no capital gains. Now, the only time you need to be concerned is if it was your main residence, then you move to a different jurisdiction like Gibraltar. You don't sell it immediately. Then once it no longer becomes your main residence. So therefore, there's potential capital gains tax to pay. Ideally, the best time to sell your UK property is either before you move or you have a final period using what they call the property private residence relief of 9 months. There are a few exceptions, but generally you've got 9 months from when that property stops being your main residence to sell it without any capital gains. If you sell it after that period, then there will be tax to pay on part of the gains of that property. Generally, the kind of growth since it's no longer your main property. So in an ideal world, if you don't want to pay any tax on that, sell your property either before you relocate or within 9 months of it ceasing to be your main property. Call this post-Brexit reality for Brits moving to Gibraltar, because there have been a lot of changes that have been brought in for a couple of different reasons. But there is a common belief that you're a UK passport holder. Gibraltar is a UK overseas territory. Therefore, we have a right for residency in Gibraltar. That's not the case. You need to apply for your residency. It's a much more lengthy and difficult process. We help people achieve residency in Gibraltar, and just from our own experience, there's more questions, that they're rejecting a lot more applications than they used to. Thankfully, we understand the process and we have our contacts, so we can help navigate people through that process. But if you are looking to do that on your own, it's complicated. There's a lot of paperwork, a lot of conditions, and it's not as easy as saying, I'm from the UK, I live here now, I want to register for residency. Now, if you have a job in Gibraltar, then you can apply on an employed basis. There's also different residency options. So the CAT2 and the HEPS, which I will get to in a little bit, they allow you to apply. The main residency scheme that people have used in the past is what they call self-sufficiency. So self-sufficiency is effectively saying, okay, I've got enough money. I won't be a burden on Gibraltar. I'll come and live there by myself. Now, self-sufficiency is now closed apart from in a few situations. And there was a couple of reasons for that. So the self-sufficiency scheme was set up when the UK and Gibraltar was a member of the EU. So it had to meet certain conditions. So now that we are outside of the EU, that system is still in place, and therefore there's certain kind of conditions that can be met. The other issue is that Gibraltar is a very small jurisdiction. They can't invite everyone and everyone. And the problem they were finding is people were coming here, gaining residency on a self-sufficiency basis. Maybe they had income from their home country, rental property, dividends maybe, and they were paying zero or very little tax in here. So there's no benefit to Gibraltar, and Gibraltar needs that income like any country. It needs the tax receipt. So self-sufficiency is closed. Now, they said this was a temporary measure, but that's been for a couple of years now. Do we see it opening up? I would say unlikely, because politically, it wouldn't go down with the locals. That people, again, coming here, getting all the tax advantages, but not contributing to the country. The only scenario that self-sufficiency is available is if you're already in receipt of your UK state pension. So if you're in receipt of your UK state pension, so you're 66, 67, I think it is now, you can transfer those rights to Gibraltar. You transfer your NHS rights to the GHA in Gibraltar. That allows you to apply for self-sufficiency. So that's a one exception. Otherwise, you either need to be employed under one of the tax schemes or self-employed in Gibraltar. Now, again, anecdotally, we've seen a lot of people come and say, oh, okay, I'm in Gibraltar. I'm self-employed, but they've not really been self-employed. It's a bit of a fudge. Maybe they have property in the UK and said, well, I'm a self-employed landlord. That's not the case. You need to be able to show a presence in Gibraltar, an activity. So if you think you may or may not meet that criteria, reach out to us and we can give you a bit of guidance, maybe look at your individual scenario and say, okay, yeah, you can get through this, or maybe not. But it depends on your individual circumstances. But they are a lot more kind of particular on the applications that are coming through. So when we talk about the residency options, and I've covered that. So self-sufficiency, if you're a pensioner, i.e. you receive your UK state pension, is possible. Before that, no. Employed, very simple. You were accepted a job in Gibraltar, you can apply for kind of residency on that basis. Self-employed, if you establish as self-employed in Gibraltar, so it's a lengthy application. You have to set up your self-employment, then you apply for the residency, then you can have that. The other options are the tax schemes. So the first one is lesser known, is the HEPS. So that is for high earn individuals, so high executives possessing special skills. You need to be earning a minimum amount of money, which increased 160k, but it does reduce you receive special tax treatment. So there's a maximum level of income that you pay on that. But to do this, you have to be recruited by a company in there. Obviously, you need to be of a sufficient position to qualify for the HEPS, and your employer may have to help you with that. And you have to be earning the minimum income requirement for it. So it is complex. Again, individual circumstances. If that's something that you are going through the process and there's a bit of ambiguity, or you're going through the process, you want help with a residency application, are you at the early stages, please reach out. The other option is category 2. So category 2 is a special tax status, and you need individual approval by the finance center director here in Gibraltar. But it's intended to attract wealthy people to Gibraltar and in turn offer them a generous tax rate. So you have to have net assets in excess of £2 million, and you need to be generating earned income. And again, due to this, they cap the amount of income that you pay. So there's a minimum amount, but a maximum as well. It's up to around kind of 40k. And now you have to pay that tax a year in advance. So if you've got a high level of earned income, it can be an attractive tax status for you. Again, it has to be on an individual basis. It depends on your circumstances, your earnings, the sort of occupation you're doing, your overall net worth. So historically, there has been a push for people to go by certain firms here to go to Cat 2, and it may not necessarily be the right thing for you. If you're not generating earned income, so income that would be taxable in Gibraltar, but then you have to pay this minimum of 35, 40k, that's not the right tax for you, because you're effectively paying tax on income streams that you wouldn't have to pay tax on if you are registered elsewhere. So there are a few different residency options, and it's important to kind of assess which one you are. For the residency application, you need property in Gibraltar. That can be rental property. You own that. You may need private medical insurance. For the Cat 2, you will need references, and you also need on any application a clean criminal record as well. So they will do a check on you on that basis as well. So we talk about tax mitigation and succession planning, and by succession planning we're talking about your estate. So again, in Gibraltar there's no inheritance tax. That's the good news. But I mentioned, and we mentioned it a lot because it's very important and overlooked, you may be liable to UK inheritance tax. So when we talk about the tax mitigation, there's a few different options. Again, we can't go into the minutiae today. Depends on your individual circumstances. So I just talk you through two of the main ones. And these are both pension schemes and very similar. So what is a QOPS? So a QOPS is a qualifying recognized overseas pension scheme. And a QNOPS is funded via the transfer of your existing UK pensions. So you built up UK pensions. We're not talking about the state pension here, but you built up UK pensions for your working life. You can transfer them to a Gibraltar QOPS. Now, why would you do that? Well, the main reason, I've covered this before, 2.5% income tax on the withdrawals, which is incredible. The other reason, and at the moment it's less powerful, but it may be so in the future, is in the UK, there was what they call the lifetime allowance test on your pensions. So the limit was 1,073,000. which had reduced over years. It was high before. And effectively, if you go over this limit, then you pay a large tax, could be 25 or 55%, depending on how you take that money. So if you, with regards to the lifetime allowance, it's assessed at different points. Your pensions have to be assessed at some point. So that's either, the last one is when you turn 75. Normally it's when you start taking an income from your pensions. But another test is when you transfer your pension outside of the UK, so move it to a QROPS. So what somebody can do, they move to Gibraltar, and again, when the lifetime allowance was in place, you transfer your pension before it breaches that limit. It gets assessed then, no tax, and then your pension can continue to grow in value. There's no further test. Or even if you're over the limit, transfer, pay a small amount of tax on that, but again, it continued to grow over and above that limit. Now, the recent budget, the Conservative budget, only a few weeks ago, they scrapped the lifetime allowance test. So you may be thinking, why is this guy talking about that? Well, really, the main reason is the Labour government they've come out and effectively said, if we get into power, we are likely to reintroduce the lifetime allowance. And if you believe the polls at the moment, they are likely to get into power. So transferring your pension now, why there is no lifetime allowance, so even if you're over that 1,073,000, there will be no test. So it's a perfect time. Transfer it now and you protect yourself from this being reintroduced in the future. Now, they could reintroduce it and backdate it. Very, very unlikely. But if you transfer it out and your pension is effectively guarded from changes in UK legislation in the future. So moving your UK pension to a QROPS in most cases is a bit of a no-brainer. Again, dependent on the circumstances. If it's a very low amount of pensions, it may not be worth doing so, but in most cases, so if that's something that you're interested in, let us know. To do so, you either have to be a Gibraltar resident, planning to move in at least the next 12 months. And then the other option is a QNOPS, which is called a qualifying non-UK pension scheme. So sometimes it's referred to as like the sister product of a QROPS. Again, it's an offshore pension scheme registered in Gibraltar. The main difference between the two is a QROPS is funded through the transfer of your existing pensions. A QNOPS is funded through lump sum investment. So you have a large sum of money that was maybe invested in the UK, you sold property in the UK, you sold your business, and you want to find a home for that. A QNOPS could be the home for some of that money. Now, one of the benefits of a QNOPS is there's no capital gains tax within the investments held within the pensions. Now, there's no capital gains tax in Gibraltar, so you may think, well, why would I use a QNOPS? So there's a few different reasons. I mean, one of them is it's a legitimate pension scheme. So in a scenario where you're subject to something bankruptcy or similar, those pension assets are segregated. They are protected from any bankruptcy. That's probably an unlikely scenario for someone using a QNOPS, but it's there all the same. The other benefit is the income tax on that is just 2.5%, the same as a QOPS. 25% of it is tax-free as well. So there's very, very little tax to pay. But in reality, if you're moving to Gibraltar, because you can use a QNOPS if you live in different jurisdictions, the main benefit will be is you contribute that money to a QNOPS. That sum of money is outside of your estate for UK inheritance tax immediately, and even if you return to the UK. So we talk about inheritance tax being something to be wary of. A QNOPS is one way, and there are many other ways, one way of protecting against that. So again, you invest the money, is immediately outside of your state for UK inheritance tax, and if you return at a later time, that is still protected because it's a pension scheme which is outside of your estate. Now, the only final thing to add on that is that the pension, the QNOPS, the funding has to be reasonable, and it has to be a genuine retirement scheme. So what they mean by that is it has to be in line with your overall net wealth, your age, maybe your health, and your income requirements in retirement. So if you, to use a practical example, somebody approaches us, they say, okay, I'm 75 now, I have net wealth of about 4 million. I'm pretty sure that I might be liable to UK inheritance tax. Let's put 3.5 million of that in the QNOPS. Great, I'm protected. It's UK IHT. That wouldn't work because it's a UK IHT fudge. Okay. But the younger you are, the better, because there's more time and you want to increase your retirement provisions, then it works perfectly well. It just has to be assessed. So as long as you're working with a professional firm, like us, of course, they can assess, okay, based on your net wealth, how much income you're looking for, your current pension, assets, your requirements and your age, this is the amount that you can invest into a QNOPS, and then it will be outside of the estate for UK inheritance tax. Okay, so we get to the final part, lifestyle considerations and the Gibraltar market. Now, I won't talk about the lifestyle too much. I think the lifestyle is very personal to an individual. Some people love Gibraltar, some people don't, like any jurisdiction, like any city or country. The only way you can really know if Gibraltar is for you is to come and visit. It's a small jurisdiction. People love that. People may not like it. What we do say is location-wise, and as someone who relocated from the UK, and as Brits, we love talking about the weather, and the climate here is glorious. And for me, from a personal point of view, that enhances your lifestyle. And it's not because someone's a sun worshipper, but it just allows you to do so much. It's such an active, outdoor, healthy lifestyle. But again, it's up to you to decide if Gibraltar is the right place for you. The property market is very important because, again, Gibraltar is a small jurisdiction, so there's limited property. There's only so much that can be built and developed. And of course, a lot of people are being attracted to Gibraltar. So it's a simple equation. Demand is low, supply is high. And therefore, if you're renting or you're buying, there's a lot of competition. So the advice that we've had from local real estate agents is, if you're serious about moving, you're looking at property, you do need to move quickly. Rental to buy, you need to move quickly. Now, there are different areas in Gibraltar. So again, if you want to talk to a property expert, we can put you in touch with one, and they can give you a bit more information about the areas, because some people might want to live in the area where the restaurants are and it's nice, bustling and busy. Some people maybe want to be kind of further back in the rock where it's a little bit more quiet. So yeah, so the property markets, but that's something that we have to really kind of warn people of. Property market moves very quickly. There's just a lack of residential property as there is. The good news, I mean, it's pretty much like the UK, but squeezed out. The good news is, and will this continue in the future? You can't guarantee, but property prices in Gibraltar are a good investment because of the demand. So the Gibraltar tax agreement with Spain. So this was rather unusual. You probably read and the tensions between Spain and the UK over who owns Gibraltar. There was a referendum some years ago where I think something like 98% of people in Gibraltar voted to stay part of the UK. But of course, there's always kind of political pressure and these things. But a couple of years ago, there was a tax agreement that was set up and agreed between Gibraltar and Spain, which was rather unusual. But there's certain factors in there that you need to take into account. And one thing I'd mention when we talk about Gibraltar and Spain is if you're relocating to Gibraltar, you need to live in Gibraltar. There are some people who think I want to live in Spain, but it's too difficult with the visas for whatever reason. I'll register as a resident in Gibraltar, but live in Spain. That won't work. People have done that in the past, and some have got caught, some of them haven't. Nowadays, it's much easier to identify these people. There's also bearing in mind where you are a resident isn't just based on the number of days you spend somewhere. So in Spain, you are a tax resident there if you spend over 183 days, if your center of vital economic interest are in Spain. Well, not just your economic interest, your familiar interest as well. So to use a practical example, say if you have an individual, they work in Gibraltar, they have a studio flat in Gibraltar, they stay in that flat most of the week. But then they have a nice villa in Spain, across the border in Sotogrande, Marbella. Their wife, or the other way around, the wife works, the husband lives there, the kids live in there, they go to school in Spain. This individual, they're spending 5/7 of the time in Gibraltar. So they're spending a lot less time in Spain, well below the 183 days. But Spain will argue correctly that their main home is in Spain. That's where their family is. That's where they want to be. That's where they spend all their free time. That's where their main residence is, the grander property. So if you're looking for some kind of fudge, you're saying, well, I want Gibraltar to be my home for tax residency, but I really want to live in the UK, Spain, wherever. That's not possible. You need to do it properly, especially if you're going to work with a firm like us, and we'll make sure that you do that properly. So yeah, the tax agreement, and that is an element of it, that Spain has the right to tax these people. So for somebody who, and I'm an example, in fact, I work in Gibraltar, I live in Spain, you pay income tax in Gibraltar, but you pay the top of tax in Spain. You're a tax resident in Spain. But one of the important parts of the tax agreement to Spain between Gibraltar and Spain is when you change residency. So the agreement states that if you relocate to Spain and you subsequently move to Gibraltar, you will remain a Spanish tax resident for 5 years. So you move to Spain, you spend a year there, you think, you know what, I want to pay less tax. I'm going to move to Gibraltar. You move to Gibraltar, but because of this tax agreement, you are liable for tax on everything in Spain, just like a Spanish tax resident, for the next 5 years. So I guess the important with that is if you are considering Gibraltar as a home, do not trigger Spanish tax residency before doing that. Otherwise, you've got that 5 years of Spanish tax residency. And that's one of the kind of key parts of that tax agreement that is little known, and I can see it happening. I can see people, maybe less so post-Brexit because it's difficult to gain residency in Spain, but I can see how people might want to move to Spain first, try out the area before moving to Gibraltar. That's the wrong way to do it. If you're unsure about which jurisdiction, then you're better off going for Gibraltar first and then moving to Spain. And then finally, we get this asked quite a lot. So at the moment, there are negotiations between the UK and Gibraltar, the EU and Spain on a post-Brexit treaty. Of course, these negotiations have been going for some time, and they're still at a bit of a stalemate. One of the aspects that they're trying to achieve, which interests a lot of people, is that Gibraltar joins Schengen for the free movement across the border. So a lot of people are interested by that, in the sense that you live in Gibraltar, it's a borderless border, no passport checks on entry into Spain. That allows you freedom of movement into Europe, which you've lost post-Brexit. Now, at the moment, this treaty is the politicians discussing it. They're keeping quite tight-lipped. There's not really many leaks about the talks. The main thing that we've heard is this is a main stalemate about the border, in the sense that the Spanish side, they want their own guards protecting the border and doing checks, whereas the Gibraltar don't want the Spanish police or guards in Gibraltar. And you can kind of see both sides of it, and the problem is, in a situation like this, will one of them cede? Again, that could be deemed as a kind of political weakness on one side. So don't a stalemate. Will they come to an agreement? They're very close, we know that, but they've been very close for some time. So it is a kind of wait and see. If there is an agreement, we will release something regarding that. So if you subscribe to our website, subscribe to our YouTube, we'll probably do a quick video on that. Maybe release a communication via email as well. So watch this space, and we will try to update. We always end with one piece of advice we would give anyone looking to move to Gibraltar. I think key is to plan in advance, consider what you're doing, and assess all your options from a residency point of view, from an asset point of view, from a tax point of view. The earlier you plan, the better. Make sure that you do things properly from a UK side and from a Gibraltar side. I guess the second piece of advice, don't try and DIY this. In the past, this might have been possible. It's a lot more complicated nowadays, and you don't want to make some mistakes that will save you a little bit of money in the short term and a lot of money in the long term. You make some mistakes and your residence application is rejected, and that's it. The door is closed. We often, come across people and they say, well, I read this on Google. I read this on a Facebook group. And often that statement precedes them saying something that's not true. And they know it's not true. That's why they're asking us, in the faint hope that we say, oh, actually, that is true. But it's usually with a statement that's too good to be true. So Google can be great. These Facebook groups have some great information. People are using things like AI now with help with these things. They are great. But to rely on them for something as important as this, it is a mistake. So partner with a professional firm, someone who knows what they're talking about on all aspects of this. So the residency, the taxation, the investments, the UK side and Gibraltar. And then you have that peace of mind and comfort that you're doing everything right. So yeah, I hope I speak to some of you soon, and I wish you all a lovely day. Thank you very much. Goodbye.